The demand loan gives the lender the right to demand repayment at any time. This type of loan is common in a single lender situation. That is, where we only have one bank providing the credit facility. It's less common for public companies because management and shareholders alike seek certainty in financing. Typically, a demand loan is less costly to a borrower as the risk to the lender is lower. Now let's look at a committed loan. A committed loan, on the other hand, requires an event of default to demand payment. This is common in a syndicate credit facility. Typically, committed loans are more costly to the borrower as the risk to the lender is higher. Committed loans are good for borrowers when certainty of financing is important and refinancing with other lenders could be difficult. Operating loans are typically committed for 364 days and renewed each year. Although every lender has its own internal processes for assigning risk, generally speaking, all lenders assign level of risk to borrowers based on the same criteria. And those criteria are things such as the historical financial performance, projected financial performance, the industry risk, the quality of management, the quality of the collateral supporting the loan, the environmental risk, and other risks such as event risks, geopolitical risks, etc. All of the above factors are assessed and quantified on some form of a scale, for example, 1 to 10. Depending on the risk rating, the bank assigns capital to a loan determined by a regulator depending on the expected likelihood of default. So the higher the default risk, the higher the compensation required for the lender to meet minimum return requirements. Okay, let's start with the most common source of fees you can expect. First, you can expect an upfront fee, an upfront commitment fee, which is essentially a work fee for the time and the effort spent on due diligence by the lender. And this typically costs you in the neighborhood of 10 to 50 basis points. Next, we have a standby fee, which is typical for committed facilities. The standby fee is charged on the unused portion of credit facilities. Expect to pay in the 10 to 25 basis point range. It may not seem fair, but it's designed to compensate the bank for holding that amount of capital available for you, even if you aren't using it. Thirdly, we have the monthly loan administration fees, or in a lending syndicate, this may be called the agency fee. And this is compensation for the monthly administrative work. For example, reviewing the financial statements or the borrowing-based calculations. An agency fee is paid to the administrative agent in a lending syndicate for performing the administrative functions on behalf of all the lenders in the syndicate. And fourthly, we have the annual review fee, which is typically only for a demand facility. Demand facilities are typically reviewed annually, which is often mandated by regulations. And the annual review fee is compensation for the annual time and effort spent on the due diligence. The amount of the fee can vary each year depending on the work required, but the amount is generally similar to the upfront fees that we spoke about earlier. Fifthly, you may have late reporting fees, and these provide an incentive to the borrowers to submit ongoing reporting requirements in a timely manner. This is important to the lender for detecting deteriorating credit risk profile as quickly as possible. And finally, and perhaps most importantly, you, the borrower, get to pay all of the out-of-pocket expenses expended by the borrower to set up the facility. These costs can be significant. For smaller facilities, you are probably looking at costs in the tens of thousands of dollars. For larger facilities, these costs may amount to hundreds of thousands of dollars. The costs pertain to legal fees, both yours and the bank's, appraisal fees, and third-party consultant fees. Let's see. We got 6 answers. Give yourself 1 point for each correct answer to a maximum of 3 points. Next question. What's the difference between collateral and security? Hit pause if you want a moment to consider your answer and earn those valuable points. Let me begin by pointing out that typically only large corporate investment grade borrowers, those are credit ratings of BBB- or better, are able to obtain unsecured credit. The rest of us will have to offer some sort of asset to the lender before they'll ever consider giving us a loan. Collateral is the asset pledged in support of the loan that can be liquidated in a default scenario. For example, trading assets such as accounts receivable and inventory, fixed assets such as land, building, and equipment, financial assets such as marketable securities, or third-party support such as corporate or government guarantees. Your loan pricing, fees, and credit structure are each impacted by the quality of the collateral you provide. Security is the legal documentation that gives the lender the right to the collateral. So security is usually drafted by legal counsel and registered in a jurisdiction where the borrower operates. And typically the lender will obtain a letter of opinion from the counsel indicating that in the counsel's opinion, the security has been properly executed and is enforceable. Now, taking an effective charge over the assets outside of the country can be problematic for domestic lenders, and you may encounter challenges if the assets pledged as collateral are located in these foreign countries. Well, a positive covenant states what the borrower will do. Some examples include provide financial statements, maintain insurance, pay all taxes. Whereas a negative covenant states what the borrower won't do. And some examples here include breach certain financial ratios, incur additional debt, pay dividends or make loans to other parties, dispose of any assets. The number and flexibility of covenants varies with the risk profile and credit cycles. For demand loans, covenants provide an expectation that the lender expects the borrower to adhere to. For committed loans, covenants provide events of default, which give the lender the right to call the loan, effectively making it a demand loan. In most cases, covenant breaches do not result in loans being called, however, but they may require covenant waivers from the lender or a renegotiation of the terms of the lending agreement.